All right, so imagine a massive financial mystery unfolding right now in the biopharma world. We've got a company that just reported incredibly strong base revenue growth, totally crushed market expectations, and even went ahead and raised its full year sales guidance. Naturally, you'd expect their earnings per share to be absolutely through the roof, right? Well, in a stunning twist, Gilead Sciences just did exactly that and simultaneously forecasted a massive earnings loss for 2026. How on earth does a company make more money on its products but project negative earnings? Let's figure it out. So, to really understand this puzzle, we need to take a fascinating look at Gilead's first quarter 2026 performance. If you look at their base business, and by that I mean everything outside of their legacy COVID-19 treatments, it actually grew an impressive 8% year over year, hitting $6.8 billion. I mean, they are performing exceptionally well commercially, yet the stock remains a complete puzzle to a lot of observers. The market is getting mixed signals, and in today's explainer, we're going to decode them. Okay, let's dive right into our roadmap for today. We'll start by unpacking the 2026 earnings paradox, then look at the HIV growth engine, how they're expanding beyond HIV, that $11.5 billion bet, and finally, we'll look at the pipeline horizon. Part 1. The 2026 earnings paradox. Let's look at this massive contradiction. The sheer scale of this contrast is honestly just staggering. I mean, look at this. Top-line sales are absolutely booming, with Gilead actually raising its 2026 total product sales guidance by $400 million, bringing the new expected range to somewhere between $30 billion and $30.4 billion. Yet, bottom-line earnings per share just dropped off a cliff into negative territory. They literally went from projecting positive earnings earlier in the year to now projecting a loss of between $1.05 and 65 cents per share. So, what's the real culprit behind this drop? Well, it's $11.5 billion. That is the staggering amount Gilead is recording as an expense for acquired in-process R&D, or IPR&D, and associated financing costs in 2026. This isn't money just being lost to operational failure, It's a massive, intentional outflow of cash for new acquisitions. We're going to investigate exactly what they bought with this mountain of money a little later. But first, we need to understand how they can even afford an $11.5 billion shopping spree in the first place.
Moving on to Part 2, the HIV growth engine. This is Gilead's reliable cash cow.
When you look at the Q1 2026 revenue breakdown, you can really see where Gilead's financial superpower lies. Despite years of diversification efforts, HIV therapies are still the absolute beating heart of the company. They make up 72% of total product sales. In the first quarter alone, the HIV portfolio brought in a massive $5 billion, which is a 10% increase year over year. Oncology and liver disease are definitely growing, making up 12% and 11% respectively. But make no mistake, HIV pays the bills. Let's break down these HIV numbers a bit more because honestly, they're remarkable. Their flagship daily pill, Biktarvy, is still completely dominating as the regimen of choice, hitting $3.4 billion in sales, that's up 7%, and it holds over 52% of the US market share. But the real explosion, that's happening in prevention, known as PrEP. The U.S. PrEP business grew an unbelievable 87% year over year. This is being driven by strong performance from their established pill Descovy and the rapid adoption of a brand new, twice-yearly injectable called Yes2Go. In fact, things are going so well that Gilead actually raised its total 2026 HIV sales growth projection to 8%. Now, I actually want to pause on Yes2Go for a second because this new injectable grew 72% sequentially just from the previous quarter alone. It was so successful right out of the gate that Gilead management increased its 2026 guidance for this single drug to $1 billion. Reaching that $1 billion mark signals clear blockbuster status in its first full year on the market, which is just a massive achievement. So why does all this dominance actually matter for long-term investors? Well, it all comes down to having a truly massive economic moat. Thanks to strategic patent settlements regarding Biktarvy, Gilead doesn't expect any major loss of exclusivity events in its HIV portfolio until at least 2036. That secures Gilead's massive cash flow for the next decade, essentially completely shielding their main revenue engine from near-term generic threats. All right, Part 3, expanding beyond HIV and looking at their new strategic moves. You see, the company knows that even a moat that lasts until 2036 won't last forever, so they're actively using that massive HIV cash flow to expand and diversify their portfolio into oncology and liver disease. However, the results outside of HIV are honestly a bit mixed right now. Let's look at the standout performers first. In oncology, their breast cancer drug Trodelvy is surging, up 37% year over year to $402 million. In liver disease, a new drug called Livdelzi is experiencing rapid uptake, with sales jumping over 200% to $133 million. But it's not all green arrows. Their cell therapy division, which includes treatments like Yescarta, actually dropped 12% to $407 million. The company noted that this drop is largely due to intense and increasing market competition in the cell therapy space. Of course, we also have to factor in the expected decline of their legacy products. Veklury, their COVID-19 treatment, predictably dropped 52%, down to $144 million due to fewer hospitalizations. Legacy hepatitis C drugs are also continuing to soften. But here is the big takeaway. Despite the declines in those legacy products and the competitive pressures in cell therapy, Gilead's cash generation is so incredibly strong that they are still actively rewarding shareholders. They just announced a 3.8% dividend hike, and in Q1 alone, they returned $1.4 billion to shareholders through dividends and stock buybacks. Which brings us to part 4, the $11.5 billion bet. This is that massive M&A shopping spree. So this shopping spree is exactly where that $11.5 billion went. Let's break it down. They bought Arcellx to really bolster their struggling cell therapy division, acquiring a highly promising multiple myeloma asset called anito-cel. They bought Tubulis to expand their footprint in antibody-drug conjugates, or ADCs, specifically targeting ovarian and lung cancers. And they acquired Oro Medicines to jump right into the inflammation space with treatments for autoimmune diseases. What this does is transform what looks like an EPS loss on a balance sheet into what it truly is: highly aggressive strategic pipeline investments across high-growth medical fields. To perfectly summarize this whole dynamic, there's a great quote from Zacks Investment Research. They point out, while Gilead's recent aggressive deal-making strategy strengthens its long-term pipeline and growth potential, the sizable upfront payments and integration-related costs are pressuring near-term profitability. And honestly, that is the paradox explained in one single sentence. The massive spending severely hurts today's profitability on paper, but it is fundamentally designed to completely re-architect the company's future growth for the 2030s. And finally, part 5, the pipeline horizon. Let's look at the key 2026 catalysts. When you map out the horizon for this company, it's pretty clear that 2026 is going to be incredibly busy. In fact, management anticipates up to 4 potential new product launches and 5 major phase 3 updates this year alone. In August, they're expecting an FDA decision on a new daily oral HIV combo. Then, in the second half of the year, we'll see regulatory decisions on expanding Trodelvy to first-line breast cancer treatment, plus some vital data on a weekly oral HIV pill. And by December, they expect an FDA decision on anito-cel, which is that flagship multiple myeloma treatment they just acquired through Arcellx. These events will very quickly validate or challenge that recent $11.5 billion spending spree. Because of all these upcoming catalysts, plus that rock-solid HIV-based business we talked about, Wall Street is actually still largely optimistic. Despite that terrifying-looking negative EPS forecast, the median analyst price target, according to Benzinga, currently sits at $133.27. Based on recent trading levels, that represents an implied upside of over 21%. It really shows a deep confidence that the underlying business growth is strong enough to absorb these massive strategic costs. Which really just leaves us with one final provocative question to think about. Will Gilead's $11.5 billion short-term hit actually secure its dominance in oncology and HIV for the next decade? I mean, is taking a massive short-term accounting loss actually the smartest, most aggressive long-term move a biotech giant can make when their core patent moat extends all the way to 2036? Time and those upcoming FDA decisions will certainly tell. Thanks for joining me for this explainer. I hope breaking this down really helped clarify the complex moving parts behind Gilead's latest earnings. Keep your eyes on those upcoming clinical readouts, and I'll catch you on the next one.